And welcome to another episode of the Property Trio. Today we are talking the January market update, and I'm joined by my two delightful interlocutors, as always, Cate Bakos and David Johnston. Good morning.
Good morning.
Good morning, Mike.
Great.
Good morning,
Or
Cate.
whatever
Great
time
intro.
of day this comes out.
What did you have for brekkie?
Voltaren.
Okay.
On which part of your body?
I had the tablets.
Oh, is it a tablet? Right.
So it's, if the TV commercials are correct, the tablets know exactly which part of the body to go and, target.
Isn't that amazing?
Sure
I love
they
it
do.
how they do stuff like that. This one's for period pain and this one's for head pain. But the reality is it's just touching your pain receptors.
Yeah.
You just
tablets
believe
don't
that
know.
that tablet's cruising through your body and finding your sore joints.
But
What sore and why, Mike? What have you been doing? What have you been training for?
This is going to
Breakfast radio,
sound like
Dave.
welcome to the geriatric podcast, where Mike has got a sore hip from an injury, from radical activities. No, just from being old and doing nothing. Oh dear. Anyway, we've got a pretty important show, so let's leave my ailments to the side. The January figures, obviously, we've got those. They've come out from CoreLogic. There's a few big takeaways. First thing I did was write the median values from top to bottom, just to get a bit of a snapshot where we are. So Sydney, Canberra, and Brisbane are your podium, with Melbourne, of course, much reported as falling under Brisbane. Now, Melinda Jennison, the current REBA president, I saw did a little interesting video about, well, actually, there's a little bit more to that story, because it all comes down to the number of houses versus units. So it is kind of like, it's not an obvious that Melbourne is cheaper than Brisbane now. It's a bit more about sort of the segmentation of property types. Now, you guys are both Victorians, and Cate, you're probably closer to the property coldface, so I'm going to start with you. What do you make of the Brisbane overtaking Melbourne story?
Well, Dave said it several times in past market updates. It's exactly right. You've got to look at the ratio of houses and units, and also understand price segmentation. You can have a government incentive, or you can have a grant. You can have something that drives a particular price point, and it doesn't mean that one particular suburb is outperforming the other. It just means that there's been a higher proportion of a lower price point of properties selling, and I think that's exactly what we have to focus on here.
And in a way, Dave, the median value print is kind of garbage in a way, right? But what else have we got?
Well, look, it's useful on some level. Like, it gives you a sort of a picture of big picture trends. The thing is, data is about taking all different points of data to then come to a perspective. And so there's micro data, there's macro data. Shout out to Melinda. I know she has listened to our podcast in the past. Maybe she got that the idea for that video from our podcast, and having talked about that ratio of units to houses in Brisbane to Melbourne previously, and sounds like she's done a video on it. And we've got a similar thing that's just occurred this month. So Perth's overtaken Hobart for median price in houses, but it already had taken over them in dwellings, but only just gone ahead of Hobart in houses. And that's again because Perth has the lowest percentage of units, but Hobart's units are 60,000, worth 60,000 more median value on average to Perth's units. So, you just have these little distortions if you look at the overall, because of this house to unit percentage differential from capital city to capital city. Yes. So you really do need to look at the dwellings and units to understand it properly.
Data does let us down like that. And even in our last episode, Mike, when we were chatting about the stamp duty concessions and how it first started in Victoria, when up to $600,000 we had a hard cut-off. If you bought for under 600, you got no stamp duty as a first home buyer. If you went 1 cent over 600,000, then you were getting the full tote of stamp duty. And you said that you looked at the data at the time wondering, what's going on with Melbourne and why our median house price had dropped. It was because we had a flood of first home buyers all incentivised to buy stock that was under $600,000.
Yeah, I think I
That's
rang you and said, Melbourne's crashed. What's happening? And you're like, I'm flat out. We're buying everything. I'm like, there's something odd at play.
Yeah.
Yeah, it's interesting how intervention can have unusual consequences. That's sort of like a loaded statement, which I'm sure we're going to revisit in the lead up to some state and federal elections. And we got the Tasmanian election coming up like a year and a half early. The only Liberal state in the country,
right.
Am I right in saying that? With a Liberal minority because 2 of the members joined the independent ranks. So it'd be interesting to see how that plays out. Will that be a bellwether for the rest of the states?
Along with the Dunkley by-election, they both should be some interesting insights for where things are heading.
Time will tell. Let's look at the dwelling changes for the month of January. Relatively flat. It's interesting to see combined capitals and regions punching side by side at a 0.4% increase. Brisbane, Adelaide and Perth were the real winners, with all of them at 1% or above, with Perth leading at 1.6 for the month, which is a big print, and 4.9 for the quarter. So, Brisbane, Adelaide, Perth really punching pretty hard, but actually Sydney annually is up a little bit higher than Adelaide. What do you guys make of that,
Mike? There's no doubt that through January, which is not always an active month for every capital city, we've seen some of our capitals doing really well. But have a look at the quarterly data for regionals versus capitals, which gives, I think, a more accurate picture when you're considering January, because it's a nothing month for some of the big capitals.
Yes.
The fact that combined regions have done 1.2 for the quarter and combined capitals 1%. Now, we all know that the really strong performing capitals have done a lot in the last quarter, but the regions have peeped them. That's really interesting. And I wonder
the regions had
Cate,
the regions had a pretty bad 2023, right? Because I suppose the exodus to the regions was much reported. And then, of course, we had the big CEOs saying, please come back to the office if you wouldn't mind. You've all had a great time swinging the cats or whatever we're supposed to do out in the regions, but we need to come back. So we probably saw them being a little bit inflated and then probably suffering from, the reversal of that. But maybe is this more of a normal number? Are we getting back to a normal sense of what the regions are about?
I think it's a bit of both. It's a new norm, and I'd love to have a close look at the specific regions that are performing well, and that's the weaknesses in this data. We only get combined regions. And, the question is, are Sydney siders feeling priced out and moving into their regions? Is Melbourne settling down? Is Geelong or Ballarat or Bendigo or one of our other regions doing particularly strong things? I know that South Australian regions are still performing really strongly. I think it would be great to get that micro data for regions so that we can have a good look at which ones really are doing something. And I haven't even touched on Queensland. We've got some significant regions in Queensland, some of which I know are doing very well.
Well, look, I mean, at the sort of summary of the housing values through the recent cycles, we can see that the regions have Queensland, South Australia and WA are currently at peaks. So they're all 50% or above where they were at the onset of COVID. Whereas regional New South Wales, Victoria and Tassie are still below their peaks of May 2022. So, look, it's actually quite reflective of what's happening in each of their capital cities. But it's interesting, isn't it? I mean, they're on a par now, but if you look at, I find it's interesting that combined capitals have hit 10% this month of growth over the last 12 months. So one of the things I think of do you remember Peter, Cate had this, one of his co-lecturers who said, property values they just follow what interest rates do.
I don't remember, but I can't see Pete agreeing with that.
Yes, Pete spoke about him a couple of times and they would have a big debate. Yeah. And so I go back and think about Pete's, the lecturer who he worked with, because, Pete would say, well, they don't, and here's history. And we've covered the history of how property movements have gone different to interest rate movements,
Yeah,
the cycle, and that's happened again. I mean, we've had our fastest growing rates on record, yet capital city prices have grown 10% now, double-digit growth over the last 12 months.
Yeah, I'm sorry, Mr. Lecturer, whoever you are, you've had a bad couple of years as your theory has been disproven. But good on you for putting the theory out there. That's how we further our knowledge.
Well, he was probably looking accurate for that first 9 to 12 months when prices dropped.
Oh, he had a blinder for that.
Yeah, and then he hasn't been going to show his face around Peter for the last year.
Before we go into the other charts, I want to talk about a couple of key things. One is inflation. So the inflation print kind of surprised on the low side, Dave, which led the RBA into probably the only reasonable decision, which was to hold. And some of the banks that are predicting 2025 would be the start of the drops are now sort of bringing that back. And there's a chance for maybe March, but there's a reasonable consensus that September could be the month that we see a drop. How are you reading it?
Yeah, look, there certainly was a positive outcome where inflation grew at a slower pace than expected. So often the predictions are around the money, but it actually fell at a greater rate than most of the economists predicted. So in terms of when the first rate reduction may occur, I'm thinking, August, September. There's no guarantees, but I think that August is when the second quarter of the full set of data comes out. So that's why it's more likely to be around August, September, because we'll have the 2 quarters of all the data received. So look, that was positive news for people who were barracking for interest rate reductions. But there's some interesting information I'll share when we come to the consumer sentiment that I feel like maybe because of the hype around rates potentially coming down, I think a lot of people who just read the headlines were potentially thinking rates might have been reduced after the first meeting in February, because some of the change in the responses to the consumer sentiment, again, were different between the RBA decision before and after.
Yeah, it's interesting.
It does sort of feels like people were sitting in their cars, Cate, with their credit card in hand, waiting for the announcement, and they're like, "Okay, is it gonna stay or go up? Stay, okay, go, run to the shops, run,
It's
Charlie, as fast as you
that.
can."
I actually found that the impact of the data that came out was stronger than the rates on hold decision. So that particular week when the inflation data came out at 4.1, after it was tipped to be 4.5. I think everyone just got really excited, said, "Yay, we've done it. We're under where they were fearing, and we'll see rates come down." And that's not actually the facts at all. And I went through the notes following the RBA meeting. I didn't pause through the minutes, but they had some headlines and quoted Bullock's statements. And what she was really clear about reminding us was 4.1 is still not anywhere close to where they want to be in the target band, which is 2 to 3%.
Yeah, still too high.
So we still have some work to do. And she did talk about the inflationary pressures that are coming down and the ones that are still not under control, namely services. And they referenced global uncertainty. Now, at the moment, we've got a lot of horrible things, waging around the world. So the key message there was that they're not ruling out a rate increase, which I think is a bit of a veiled threat to keep us all at bay. But also they are determined to get us into that 2 to 3% band, and they use that word determined. So my read of that is I think we're probably jumping to conclusions, picking where we think a rate increase could be. It wouldn't shock me if it was at the very end of the year, and it wouldn't shock me if it was next year. I think we're definitely heading in the right direction, but everyone's still being very, very cautious.
I think you're right. What's interesting is that in the notes from the announcement, they said we're looking to get back in that 2 to 3% range by the end of 2024, and not in the midpoint of that target until mid 2025. So they are very patient in getting it back there. And Michelle Bullock says herself that the cost of living pressure is really because of inflation. That is what's eroding people's capacity to feel okay with their finances. So inflation is the real devil in this situation, and hence their determination to go after it, right?
Yeah.
One of the positives was because services inflation had been quite sticky. Services inflation actually fell a reasonable level, which has now fallen 2 months in a row, because that was the one that was still increasing, even though goods had started coming down. So that was a positive sign as well. But yeah, look, I think there's still a possibility we mightn't have any rate reductions this year, depending on how rapidly things keep coming down. And often, you know, the last mile's the hardest when it comes to taming inflation. So, you know, we shouldn't be getting too excited just yet.
Thanks for putting a big lump of coal in our Santa sacks, Dave.
Hey,
really
it's looking
appreciate
positive. I just don't think people should assume that rates are going to drop.
It's green coal.
Yeah, no, fair enough. And I think some of the spending data is giving us an insight that maybe people are getting a little bit too enthusiastic, but we'll come to that. So in terms of rents, we've obviously seen annual change in rents in places like Perth and Melbourne, you know, over above 10%, which is pretty high. And, you know, the rest of the country outside of, say, Canberra, Hobart, and to a lesser extent, Darwin are very modest. But Dave, you had some points you wanted to cover off on rents. What are you reading?
Yeah, so just inside the data a bit, the first quarter, the National Rental Index recorded its strongest monthly rise since April. So rents are up, for January, rents are up at 0.8%. So they've jumped up again versus 0.6% in December. So the strongest monthly rise since April. So we've talked a bit about that there can be a bit of a lull towards the end of the year, and then they can rise again early in the year, because that's when a lot of people are looking to settle on new dwellings. And so most years see rental growth acceleration in that first three months of the year. So it looking like a similar trend this year. Yeah, so that was one of the points. I've got a couple others, but
I'm really concerned.
That's all right, David. Hit us.
It's going to get worse. I'm talking to the agents, and they're all reporting the percentage of rental properties that they're selling is disproportionate. I mean, in some cases, 90% of their listings are rental properties. That's going to bite. It can't just we can't expect the data to stay the same. I think we're looking at these horrendous increases, and you know, quite a few capital cities are showing that for both houses and units, we've had circa 10% increases over the past 12 months. If that continues at 10%, 10%, 10% every year, that's not great at all for renters, because it's not like we're having one really strong year and then things settle down. They're getting hit with 10% increases year on year. My concern is it will be greater than 10%, because we're seeing a lot of stock getting sold.
And to put that into context, a 10% reduction of private rental accommodation when investors are supplying around 91% of private rental sort of means that for social housing to keep pace, it's almost got to have like 100% increase at the same time. Now, don't quote me on the maths, but social housing has been stagnant for at least 5 or 6 years, right? And we've seen natural population increase and a huge increase in international migration. So there is nothing but pain for me in the data. The only reason why I predicted in 2024 rents wouldn't rise as much as 2023 is because I believe people will change their behaviours and they will bunch up. The density of houses will increase. People will stay with their parents if they can. People will rent out their rooms, and that will perhaps ease the pressure to some degree, but gosh, it's not looking nice out there for anyone looking for a rental property.
And a very small catchment of renters can actually choose to do that. You know, singles or young couples, you can talk about house sharing or moving back with parents, but families won't do that.
Yeah.
Yeah, and as I spoke about last episode, I think there's going to be even less housing stock available, because I think people who own investment properties with high land value are really feeling the pain with increased land tax. And so anecdotally, I'm seeing people and hearing stories of people selling high value investment properties because of the land tax impost. And, maybe that's part of what one trend that's just starting to play out is that house rents are growing faster than unit rents for the first time in quite a while. So across the combined capitals, house rents rose by 2.5%, compared with 1.4% lift in unit rents across the quarter. So part of that is probably, that we're slowing down migration a little bit as well. But I just feel like anecdotally we're going to have less good quality housing for people to be able to rent. So the competition is so fierce for houses. And again, you hear stories of three or groups offering above what's being asked for the rent for the house, when and the number of people going through these houses, it's a really difficult time if you're trying to rent.
And I really worry about some of this sentiment in and around investor concessions and whether they have a part to play in Australia. I think you could let's argue that once we've sorted out the social housing and the need for housing, because I think any more exodus of investors is going to lead to a really nasty situation that I think is sociologically significant and will result in huge increases in homelessness, which is really horrifying. Anyway, that's another show, and it probably shows that we've done before.
Well, that's actually probably a bit of the show we'll be doing next week, isn't it?
Yes,
Part 2 on what a healthy property market looks
true.
like.
And, we're all on notice to bring our best and brightest innovation. And
I got some ideas.
Good. I've been up nights sweating, thinking, "Gosh, would that move the needle?" So we'll look forward to that.
Kate, nothing a bit of talcum powder won't fix.
You said it, Dave.
I'm not even going to explain that joke to people. Let's talk about sales volumes. So part of the reason why house prices did so well in 2023 is that there wasn't a lot of sales volume happening. Now, people were saying, okay, well, maybe the market's going to sort of slow down a little bit because we are seeing an uptick in sales, but we're also seeing that get hoovered up at a rate of knots. Auction clearance rates are very, very positive. So, I mean, there's not a flood of extra listings. There's a bit of an increase, but how are you seeing it, Cate?
I think the January portion of the chart shows exactly what we expect January to do. Our heavy-hitting capital cities have a bit of a hiatus over January, and it absolutely shows that. But if we have a look at the 6-month moving average, that's the one to really have a squeeze at. Late last year and still as at January 2024, it's showing to be just above the 5-year average. So we had our volumes increase in the latter half of last year, and we all know that. I think what's really impressive is that prices held firm and grew in most of the cities, because we did see stronger listing volumes, and I thought that might have diluted the buyer pool a little bit and given rise to some price falls, but it didn't. We've got appetite is matching supply at the moment.
Yeah, it's an interesting one. And if you have a look at total property listings, I mean, they're all down for January, which makes sense. Almost kind of makes us a bit of a useless print. But if you look at the yearly change, it's really interesting to see Brisbane, Perth and Adelaide, which really are amongst the top performing markets. Their yearly change in listings are all down, whereas the others are all up. And you look at Canberra and Hobart, we've talked about being in the doldrums. They are leading the charge in terms of yearly change in listings, with Canberra at 24.4% and Hobart at 18.1%. So it's nice
Perth,
when
that's 23.5% lower than it was a year ago. No wonder Perth's flying. Everybody wants a piece of it, and there's 25% less stock.
Once again, this great correlation between the number of listings and the growth or falls in a property market in a city, isn't there? Like a really strong correlation.
Yeah, and you could say the same about old listings and distressed listings. So a yearly change of negative 29%, negative 30, and negative 13.2 across Queensland, WA, and South Africa, I nearly said, respectively, South Australia. But one thing I put a little asterisk was the monthly percentage change in distress listings for Victoria is actually down negative 3.7% on a yearly change of 17.8. So I wrote a little arrow and said green shoots, question mark.
Could they be? Or is there a reason why distressed listings didn't take place in January? You know, a Melburnian's condition to say, let's wait until the market returns. I don't know. It's one data point, so we can't draw a conclusion yet, but I'll look forward to seeing the next chart and seeing if there's a sign of green shoots, because up until then, you know, Melbourne New South Wales, Victoria, Northern Territory and Tassie are the ones that were showing an annual increase in distressed listings. But the fact that Melbourne's had a pullback in the monthly change, that has me intrigued.
There's certainly a few markers that Melbourne is in the cycle relative to the other capital cities starting to show value, let's say. So if we look at, the other capital cities, the growth since the onset of COVID, I mean, you've got Brisbane, 52%, Adelaide, 53%, Perth, 49%. Then you've got Hobart, 27%, Canberra, 30%, Darwin, 24%, Sydney, 24%, Melbourne, 10%. So there's a solid difference there. Obviously, the median value of Melbourne is still, I'm talking the ones that actually matter, not the overall, because it's distorted, as we discussed, based on the number of units or houses. But Melbourne is still 26,000 below Canberra's median value for houses, which is historically unusual. So there are little signs around that Melbourne is, moving into a place of relative affordability. At some point, you do start to see investors starting to move to capital cities when those sort of markers become strong, and then that tends to sort of build its own momentum over time. We're well and truly have seen that now in Perth, haven't we? Like where everyone, is talking about Perth. So let's watch this space.
But when it comes to affordability and the great state of Victoria, you can't afford a Commonwealth Games. You can't afford not to tax investors with land tax. Is your state bankrupt? Is everything okay?
Do you know what? If you came to visit and you looked at some of the civil infrastructure projects that are underway, our city is in absolute gridlock because every main road and second train line is closed down. We're doing a lot of stuff. They've spent so much money. I just really hope it eases moving around and it gives us a few points on the scorecard, because we have had a bit of a hard time. But what I will say is they're spending a lot of money, and it's taken a lot of our tradespeople out of their trade and into these projects. It's really shaken up our city. So let's hope that it's a positive at the end of it all, and I think it will be. But we've had a bit of pain.
Well, you get a multi-term government in for almost a record period of time. They get pretty confident in the policy changes they're willing to make. And, that's what we're seeing there. Not everyone's happy with those policy changes. But as we know, they only need about 51% of people to be happy with them, and they stay in power. So, yeah.
You guys have had a bit of a rough ride over the last probably 3 or 4 years. What hasn't been a rough ride was the consumer sentiment print for February 2024. Really, all 5 indices improved, and the index itself is the highest since June 2022. So a little bit of optimism. What were the standouts for you guys?
Oh, the one I didn't want to see, to be honest.
Yeah, people buying toys.
Yeah, it's going to drive inflation.
Yeah. time to buy a major household item is up 11.3% for the month and only 11.2% for the year. Yeah. So it's like you say,
people have jumped back on the train straight away.
They have. We've got a chart coming up in the finances section, and it relates to personal loans for discretionary spending, and not only on non-tax deductible goods, on non-goods. So stuff like travel. We'll chat about it, but it's bothering me.
Well, if you look at the sort of the economic finance ones, not the property or interest rate expectations, you've got family finances next 12 months. That's up at 95. People are feeling pretty confident overall, despite all the rate rises. That's nudging 100. Now, part of that is most people think we're at the peak. So they feel like, look, we're only going to get more savings. There's now more tax cuts coming in for a larger percentage of the working population. I think it benefits about 70-odd%, maybe a bit higher even, with the changes that Labor have made. So I think people, and then economic conditions next 5 years is up at 93%. So people are feeling much more positive. It's still not at 100. So it means, less than 50% aren't positive, but it's moving towards real positive territory there, isn't it?
It is. And the two that I always grapple with, and Mike, you've put it together before and drawn a relationship, but house price expectations index is up to 161.4. That's a big number. That's the vast majority of people loudly saying that they expect house prices to move. Yet time to buy a dwelling has moved up from 72 to 74.2. So that means that most people feel it's not the right time to buy a dwelling. So people are saying we expect dwellings to go up, but not yet.
Yeah. Or it's sort of like, gosh, it's going to gallop away, but I haven't got the money to get involved.
Yeah, that must be what they're thinking.
Well, I wonder what that question is when it's put to people, time to buy a dwelling. Do you think that in the context of this now would be a good time to buy a dwelling, or is it a question saying, do you want to buy a dwelling right now?
I'd love an answer for that, but we're going to have to speak to the
How do we get this? I would love to grab this poll and see what they ask and how they ask, because it would give us a lot of context.
I think they a lot of it's their IP, and they try to protect some of the.
How can we get it? Who do you know on the inside?
So, look, one thing I found out is just with the time to buy a dwelling index, they break people up into 55 subgroups.
Right.
So, it's really detailed and in depth in terms of the subgroups that they analysed within it. But consumers who own investment properties, so this was something that was out this month in time to buy a dwelling, people who own investment properties were the only subgroup of the 55 that have an outright positive view.
That's interesting.
Yeah.
So you've looked behind the curtain a little bit, Dave. How far back can you go?
Well, it's just little tidbits like this that I sort of find, and they do share. So what else was there? Buyer sentiment posted a bigger rally in Victoria. So that was another little green shoot. I thought I saw a few little green shoots. So it was actually up 13.9% in Victoria as being a good time to buy a dwelling. So it jumped up to 78.1. So it was low at 65. Western Australia jumped 21% to 87.2.
My goodness.
So, yeah, people are very buoyant on WA, but I think they're starting to see the value in Victoria as well.
Yeah. And what impact do you think our tight rental conditions are having on discretionary renters? I think that has to be an obvious link to join, because anyone who's renting by choice right now, not by circumstance, but by choice, might be looking at the cost of renting or the ease of or the difficulty in finding a rental and saying, it's going to be a lot easier if I just buy something. I wonder what sort of impact that's having.
Yeah. I think that's having a big impact. I mean, I can just think of a couple of friends who have been renting by choice, very well-off, successful people, and they've, one of them's doing small-time development and been waiting to sell that, and owns property in Sydney, etc. And it's so hard to find a rental, and they're going to get into the property market now and buy a home, and another one in a similar situation. Yeah, like again, it's anecdotal at the coalface, as we say.
It is, but that is how we get a glean on what's going on. And I've got clients that are coming to me saying, my friends introduced me to you, and I've been renting. I've been really comfortable. It's been a really good arrangement, but I've been given notice to vacate, and I'm ready to buy something. It's the push I needed. Or they might just say it's the rents have gone up and up. It's actually not viable. I'm better off putting the extra payments into a mortgage. So I'm certainly getting that as well, Dave. I've had a significant uptick in people that have been renting, and now they've decided it's not ideal and not working for them.
Lending Indicators, which was published on the 2nd of February, saw an interesting little jump in investor activity. Now, in my view, not enough to make up for the mass exodus of investors, but owner-occupiers and investors for housing have gotten a little bit jazzed up in the latest read. Cause for enthusiasm, green shoots, or Cate, are you going to be annoyingly sensible and say, look, it's just 1 month?
No, I'm not going to say that, because while we've got a percentage change for Jan, it's been steadily increasing. I think there's a combination of reasons for investors to turn back to the market. A lot of people do like to try and time it, and they've been listening to inflation data and to RBA headlines and determining that if there is an interest rate drop, then we might see what happened in 2021. And nobody wants to miss that train ever again, and no one wants to get priced out. So we've certainly seen a lot of people getting their finances together and making that decision to get in early. I think from a Melbourne point of view, I'm only one BA working in one state, and we'd have a lot of good intel from BAs across the nation if we polled them. But the investor activity I've had here has increased, but it's mainly been from overseas and Sydney people. So I've had one Brisbane investor, but everyone else has been Sydney or an Aussie based overseas who might ultimately want to return soon. So that's pretty telling, looking from afar, but I haven't had a deluge of local investors. I've had a couple, but not a lot.
Interesting.
Yeah. I think, if we come back to that time to buy a dwelling index, if it's at 74.2, but people who own investment properties are above 100, I think that goes to precisely what you're saying. And I also think the early tick up in auction clearance rates is an early sign that the property market's possibly going to be more buoyant than we expected this year. And people are watching because they know as soon as the first rate reduction takes place, more and more people will jump in, and people are getting more savvy around trying to pick to get in at the right time. And so I think, that's part of what's playing out there.
Yes.
Well,
I think we all just saw that impact of ultra low interest rates and how the property market flew and how traumatizing it was for anyone that was navigating it at the time. I was only joking around with the Ballarat agents yesterday and catching up with them while I was up there, and they were talking about how different the conditions were, and they had never experienced conditions like that. And I said to the agent when I looked at a property that had a lot of appeal, so, how long have I got? And he said, what do you mean? I said, well, last time I saw you was quite a while ago. It was during the heat of your market. And I got a phone call while I was on the Western Highway heading your way saying, hey, I've already got an acceptable offer and 4 others, and you've got until 3 o'clock. Do you reckon we can bring our inspection earlier? And that was not what I wanted to hear. Whereas, this time round, very different. It was back to normal conditions. People were scarred by that. They don't want to go through that again. They'd rather beat the crowd.
Yeah, and I've talked about this before, but I think because we're more data driven than ever before, there's more data. It comes out faster. Cycles turn faster and move more rapidly than they ever have, and that's part of that picture as well.
Yeah, that's an interesting insight, Dave, because the last drop in the market was the fastest, I think, on record, or at least since the 70s, as far as the graph I was looking at. And the turnaround pretty rapid as well. We've seen the most rapid rise in rents, rapid rise in interest rates, so everything's kind of on steroids. Speaking of steroids, what's on steroids is personal loans. Now, This is a little bit of a worry, right? Because we all kind of want the RBA to cut rates, except that guy I talked about who was in the paper saying he wants interest rates to be at 20% because he's got all of his cash in the bank. Apart from that one guy in Victoria that was quite happy to make
he
himself...
had to live in Victoria, didn't he?
Yeah. You know what? He almost... I'm not even 100% sure that he did, but I'm lumping it on you guys anyway.
Good on you. Good on you, Mike.
So household and personal goods and travel and holidays, we've seen an uptick. It's a worry, Cate. What worries you about it?
We're trying to stave off inflation, and we're not only spending our money on stuff that is not an asset and not deductible, we're spending our money on something that's gone when it's gone, and we're using credit to do it. So we're putting a lot of pressure on ourselves and our household debt levels when we go borrowing money to buy stuff that is gone when it's gone. So I think that that's a terrible sign that we've had an uptick in household and personal goods and holidays with personal lending. And let's be different, but let's be clear about the difference between personal loans and, accessing equity or home loans. You're dealing with much higher interest rates. It's unsecured debt, and it's very hard to pay off. Your loan terms aren't 30-year loans. They're usually something closer to 10 or 12 years. And so you're placing a lot of pressure on your repayments as a household when you go and do something like that, and you're driving inflation at the same time. It's only not so precarious right now because we've had wages growth and we've got really healthy unemployment levels. But if either of those changed, it could be a really horrible concoction of bad outlooks for households that are carrying unsecured debt, in my view.
Well, the RBA have said that we can expect the unemployment rate to increase. It's really only got one way to go, and as we see international migration, obviously we've got a greater labour supply, and perhaps that fed into the services inflation drop. But Dave, are we annoyed with having to budget and all of our groceries are too bloody expensive, and we see some positive signs on inflation and think, bugger it, let's get a loan and hope that the variable rate will just drop, and who cares, we're going to Bali?
Yeah, look, I think there's a lot of those sort of habits and behavior when it comes to money management, and that's historical. That's a long-term trend that people do tend to spend and not love to budget and save. And I guess if you see some green shoots, if you like, that we've reached the top of the cycle. We're also coming through the Christmas and January period. It's a bit easier to convince yourself. You don't have to look at the bottom line as much over that period. So, but we know that rate rises or falls generally take 1 to 2 years to play out. And I think it's just that's a slow moving train wreck, if you like. And we'll see that pain come through further in the economy later this year and into 2025. And that's when, we will see actual rate relief in 2025, maybe in 2024.
If people don't get too excited with personal loans. Unemployment rate, steady at 3.8%, which is incredibly low. The wage price index is still showing where, it's the greatest pace of wages increase in about 26 years. When it comes to bonds, GDP prints, what's your read on that, guys?
Well, 10-year looks like it's really leveled off. So, and look, the 3-year, I would say a similar thing. I think that we're reaching close to equilibrium, and that might not be joyous for people to hear because everyone wants to see rates drop again. But we've returned to historical normal levels now. So if we do have a drop in interest rate, I don't foresee it being a massive drop. I think now we're just really tweaking the dial and getting back to equilibrium. And hopefully there are no other headwinds that force us to have to go into emergency levels again, because that in itself means that something's going wrong globally, but also we don't want to see them creep up again either.
Yeah, it's interesting, is it? Like 3-year bond yield, they're suggesting, okay, on average over the next 3 years, we'll probably see our rates be about 50 basis points lower, or normal 0.25 rate reductions below where we're at now.
Yeah.
But then the 10 years says they expect us to be around the level we're at now on average over the next 10 years. So that's worthwhile for people to hear, that, you know, where we're at now is sort of where the bond markets think the next 10 years would likely sit. I mean, a little bit of an outlier is the RBA still considers their neutral rate at around 2.5%. So that implies they think that rates need to come down a lot further. They haven't changed that
great.
yet, but
yeah, we'll take that.
Everyone with debt will like that.
Send your comments to governor@rba.gov.au for what it's worth. All right. If there's nothing else from the two of you, we'll go into our gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
My gold nugget is simple. People, we need to bring down inflation. Stop spending on discretionary stuff. Or at the very least, don't be using unsecured debt to do it.
So a couple of little tidbits that I also had that I'll share in my gold nugget. So house values have continued rising at a faster rate relative to units, and that's made the gap between the median capital city house and unit values at a record high ever. So on average, the house medians are at 45% or 45.2% above the unit medians. So that's an interesting little insight. So capital cities, the housing values rose by 0.5%, but units just 0.1%. And just one other little tidbit, that even though rents are still flying again, we're only at an average gross yield of 3.73%. So this is the relativity of rent to the value of our properties. That's slightly below the decade average of 3.78%. So, you know, we are only at sort of an equilibrium of the average relative rent to dwelling values. Now, you can argue dwelling values are much too high relative to what they should be in our country, et cetera, but it doesn't always work out like that. So it wouldn't surprise me if rents, like we've talked about, keep outpacing or at least keeping up with the pace of growth with property values, because we're just at our 10-year average yield at the moment.
My nugget is a bit like with Cate. If you are going to buy something, don't make it a holiday, make it a toy, and make it secondhand and pay cash so the RBA can't see you do it, because we don't want them to know what we're up to, because we want the rates to drop. Also, gold nugget is a little tip. If you didn't listen to last week's episode where we talked about housing innovation, housing affordability, and an adequately or an appropriately functioning market, check that out, because next week we are going to, us trio of people, give our insights into the innovation that we think could actually move the needle and achieve a lot of the outcomes that people are screaming for. Until
Thanks
then,
for that, Mike. You just saved me having to do the teaser. I didn't have to go in next week's episode.
Did you? Well,
thank
I didn't
you.
do it in my
Cue
radio
Jamie.
voice. There you go. We'll see you next week.
See you next week.
See you
guys.
later.